Watch. Federal Reserve Chair Powell speaks after Fed announces interest rate cut. Washington, AP. The Federal Reserve on Wednesday cut its benchmark interest rate by an unusually large half-point. A dramatic shift after more than 2 years of high rates helped tame inflation, but that also made borrowing painfully expensive for American consumers. The rate cut, the Fed's first in more than 4 years, reflects its new focus on bolstering the job market, which has shown clear signs of slowing. Coming just weeks before the presidential election, the Fed's move also has the potential to scramble the economic landscape just as Americans prepare to vote. Watch Jerome Powell's remarks in the player above. The central bank's action lowered its key rate to roughly 4.8%, down from a 2-decade high of 5.3%, where it had stood for 14 months as it struggled to curb the worst inflation streak in 4 decades. Inflation has tumbled from a peak of 9.1% in mid-2022 to a 3-year low of 2.5% in August, not far above the Fed's 2% target. The Fed's policymakers also signaled that they expect to cut their key rate by an additional half-point in their final 2 meetings this year, in November and December. And they envision 4 more rate cuts in 2025 and 2 in 2026. Watch. Chicago Fed President expects multiple interest rate cuts amid economic overcooling. In a statement, and in a news conference with Chair Jerome Powell, the Fed came closer than it has before to declaring victory over inflation. "We know it is time to recalibrate our interest rate policy to something that's more appropriate given the progress on inflation," Powell said. "We're not saying mission accomplished, but I have to say, though, we're encouraged by the progress that we have made. The U.S. economy is in a good place," he added, "and our decision today is designed to keep it there." Though the central bank now believes inflation is largely defeated, many Americans remain upset with still high prices for groceries, gas, rent, and other necessities. Former President Donald Trump blames the Biden-Harris administration for sparking an inflationary surge. Vice President Kamala Harris, in turn, has charged that Trump's promise to slap tariffs on all imports would raise prices for consumers even further. Rate cuts by the Fed should, over time, lead to lower borrowing costs for mortgages, auto loans, and credit cards, boosting Americans' finances and supporting more spending and growth. Homeowners will be able to refinance mortgages at lower rates, saving on monthly payments, and even shift credit card debt to lower-cost personal loans or home equity lines. Businesses may also borrow and invest more. Average mortgage rates have already dropped to an 18-month low of 6.2%, according to Freddie Mac, spurring a jump in demand for refinancings. "It's a step in the right direction," Laura Rosner-Warburton, senior economist of Marco Policy Perspectives, said of Wednesday's Fed move. "The additional rate cuts it indicated it will make," she said, "will prevent risks from building and the unemployment rate from rising. They are trying to keep the economy in good shape." In an updated set of projections, the policymakers collectively envision a faster drop in inflation than they did 3 months ago, but also higher unemployment. They foresee their preferred inflation gauge falling to 2.3% by year's end, from its current 2.5%, and to 2.1% by the end of 2025. And they now expect the unemployment rate to rise further this year, to 4.4%, from 4.2% now, and to remain there by the end of 2025. That's above their previous forecasts of 4% for the end of this year and 4.2% for 2025. Powell was pressed at his news conference about whether the Fed's decision to cut its key rate by an unusually large half-point is an acknowledgement that it waited too long to begin reducing borrowing rates. "We don't think we're behind," he replied. "We think this is timely. But I think you can take this as a sign of our commitment not to get behind. We're not seeing rising unemployment claims, not seeing rising layoffs, not hearing from companies that that's something that's going to happen." He added, "There is thinking that the time to support the labor market is when it's strong and not when you begin to see the layoffs. We don't think we need to see further loosening in labor market conditions to get inflation down to 2%. The Fed's next policy meeting is November 6th to 7th, immediately after the presidential election. By cutting rates this week, soon before the election, the Fed is risking attacks from Trump, who has argued that lowering rates now amounts to political interference. Yet Politico has reported that even some key Senate Republicans who were interviewed expressed support for a Fed rate cut this week. Powell pushed back against any suggestion that the Fed shouldn't cut rates so close to an election. "We're not serving any politician, any political figure, any cause, any issue," he said. "It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up, too. It's a good institutional arrangement, which has been good for the public, and I hope and strongly believe that it will continue." Powell's characterization of the economy as fundamentally healthy, with inflation under control and employment stable but likely to benefit from rate cuts, was an unspoken rebuttal to Trump's warnings that an economic disaster is near. The Fed's move Wednesday reverses the inflation-fighting effort it engineered by raising its key rate 11 times in 2022 and 2023. Wage growth has since slowed, removing a potential source of inflationary pressure. And oil and gas prices are falling, a sign that inflation should continue to cool in the months ahead. Consumers are also pushing back against high prices, forcing such companies as Target and McDonald's to dangle deals and discounts. The Fed's decision drew the first dissent from a member of its governing board since 2005. Michelle Bowman, a board member who has expressed concern in the past that inflation had not been fully defeated, said she would have preferred a quarter-point rate cut. But the Fed's policymakers as a whole appear to recognize that after years of strong job growth, employers have slowed hiring, and the unemployment rate has risen nearly a full percentage point from its half-century low in April 2023 to a still low 4.2%. Once unemployment rises that much, it tends to keep climbing. At the same time, the officials and many economists have noted that the rise in unemployment this time largely reflects an influx of people seeking jobs, notably new immigrants and recent college graduates, rather than layoffs. The Fed's attention now is preserving the health of the labor market and preventing unnecessary damage to the economy.